Well, good afternoon, everyone, and thank you for joining us for this Moomoo presentation. I'm Michael McCarthy, CEO and market strategist at Moomoo Australia and New Zealand. And today we have a very special guest with us. Today on my right is Phil Mackintosh. Phil joins us today from the Nasdaq. He's the chief economist, the global chief economist for the Nasdaq exchange. And Phil's background is very similar to mine. We're both market strategists and traders by background. So Phil, while he takes an economics lens in his current role, is very much at the heart of the question that we're all trying to answer. Where should I be investing and when? So I'm not going to give you any preview of Phil's presentation. Phil's a man who spends his life giving presentations to investors and traders. So without carrying on any further, I'd like to hand over to Phil Mackintosh of the Nasdaq. Thanks very much, Phil.
Thanks for having me. And I do love charts. So one of the things I'm going to do is drive a few charts just to show people what's going on in the economy.
Terrific. Let's get your presentation up here.
Okay.
And get those charts rolling.
Okay. And I'm going to talk basically about three different topics, which you'll see they're interrelated. This year for me has been a lot about tariffs, which probably won't surprise anyone. So we'll talk a little bit about what the US government is trying to do with tariffs and how we think it'll affect the different countries around the world. And then we'll pivot into what's driving the market and the economy. And really, it's not tariffs. You're going to see what it is. And one of the things it is, I'll give it away, is AI. And so then we'll talk a little bit more about AI and how much that's affecting the economy and obviously stock selection as well. So let's start by talking about tariffs. And it's been kind of tough for someone like me to even keep track of what's going on. Some of the economists in the street are keeping track of how many days between new tariff news. And it's running at about 2.5, 3 days between news announcements, even with a 90-day pause, even with the fact that we now have a lot of deals done. You can see the blue line in this chart, the way the tariff rate has changed through time. In January, we had the first threats on Canada, Mexico, and China. But really, the big news was in April when we had the Liberation Day reciprocal tariffs announced. That was a massive increase in the total tariff rate, and it obviously affected a lot of countries around the world. And what's driving the US government to do the tariffs is kind of an interesting question. I was lucky enough to hear one of the White House economists talk through the sort of logic behind the tariffs. And really, a lot of what they were talking about was deficit driven. And the first deficit they talked a lot about was the fiscal deficit, which is when the government is spending more than it's raising in taxes. So if you look at the US debt to GDP ratio, which we show here, you can see it's been creeping up pretty quickly since sort of the 2000 period. And it's now at a level about 100% of debt to GDP as a ratio, which we haven't had really historically, except for at the very end of the Second World War. A lot of countries around the world have pretty high debt to GDP ratios now, but the US is higher than the UK, it's higher than Europe. It's not as high as Japan, which you can see pointing way off the chart there at 250%. But the problem, I guess, for America in terms of affordability of the debt is the dashed line shows the projection, which is that the debt to GDP is meant to be getting worse, not better. And the reason for that is what you see in this chart. So this is looking at the government spending on the top and the government tax revenues on the bottom. And this is before the Big Beautiful Bill. So actually some of the income lines have been shrunk by that. But the big point to really focus on here is that shortfall where the tax revenues are at least $1 trillion short of all of the expenses that are going through every year. And I think if you look at some of those expense lines, Social Security, Medicare, and Medicaid are all things that are paid to retired aged people. And so as the US economy or the US population ages, the costs of those are actually going to go up, not down. Even the interest expense item, if we can get interest rates down a bit, that will help. But as the debt goes up, obviously the interest expense line will be kind of growing as well. And so it's pretty hard to tackle the deficit without doing something. And that's where tariffs come in. You can see the gap that they're starting to close there already. And so I think broadening the tax base with tariffs is something that they've consciously done to try and address some of the imbalances. Speaking of imbalances, the other deficit that they talk a lot about is the trade deficit. And so if you look at this chart here, what this basically shows, the US economy is a very consumer-driven economy. The consumer loves to spend a lot. And we, as an American consumer, buy more from overseas than we export to overseas. And you can see that's been the case for the last 30 years consistently. And so that's an imbalance. At some point, we have to actually earn money from exports to be able to pay for all of this. And that's the theory, is to try and tackle some of this imbalance as well. The reason that they really want to tackle this imbalance, though, is because if you look at the economy in more detail, which we show in this chart, the economy has shifted from 50-50 goods and services on the left of this chart to about 60% services, 70% services, and 30% goods. But more importantly, you also see that the imports have become much bigger as a proponent of the goods segment. And so the amount of goods that are made in America, if we look at the vertical pink bars, has shrunk considerably. And the reason that's a problem is what you see in this chart. So the pink line in this chart is showing the number of workers in the United States employed in the manufacturing sector. And it's gone from a high of 1 in 4, well, a high on this chart of 1 in 4 back in the 70s to less than 1 in 10 now. And the theory is manufacturing jobs are relatively well paying. They're going to be paying more than Starbucks jobs, Walmart, shelf stocking jobs. And so you want to try and get people into manufacturing jobs where they can work their way into middle income and higher middle income families and actually have a better quality of life. And so that's a big focus of the government and of the tariffs, is to try and encourage the growth of the manufacturing sector. So let's talk a little bit about tariffs. And the way that the reciprocal day tariffs were announced really does reflect what we just talked about. So the red line here is showing the Liberation Day proposed rates. If you look at the horizontal axis, that's showing on the left-hand side countries that have a trade surplus with the US, where actually the US exports more to them. And then the countries on the right-hand side are the countries where we have a trade deficit. And you see the hockey stick shape of that red line at 20%. So once a country has a large trade deficit with America, they had a higher tariff rate. And the theory was that I guess the more competitive advantage the country had that enabled it to do more exports to America than America exported to it, the more you needed to manufacture a solution that kind of made it more competitive or cost disadvantaged for those imports to come into America. Where we've landed is actually where the dots are right now. And you'd see the circles sized by the amount of trade that we do with them, that America does with those countries. So we're much flatter. A lot of countries are in that 10 to 15% range, even to the right-hand side, not many over 20%. So the competitive advantage of being one country over another has kind of been normalized. But you can see pretty clearly these are big tariffs compared to what we had just a year ago. So the big question, I think, is who will pay for the tariffs? And I think the starting point is this chart, which shows that someone is paying for the tariffs. This is looking at revenues per month coming into the US government from tariff collections, and it's running at about now nearly $30 billion a month. So it's real money. It's really closing the gap in terms of broadening the tax collection base in the US. You can see the rest of the world, which is the blue color, is definitely increased much more compared to where they were. So you can see the broadening across all the different countries of the different participants paying the tariffs. The big question is, and this is more an economic question, is the elasticities of all of the different products will determine who actually pays. Will the businesses in the US pay? Will they actually contract margins so that they can still sell to consumers with the same prices they used to have, and, as Trump say, eat the tariffs? Will the US consumers see higher prices for the goods that are tariffed? Or will foreign exporters actually cut the price of their exports so that they don't see less demand for the things that they used to sell to Americans? And so all of these are possible outcomes. I suspect with different products, the elasticities will determine who really pays. But some of the regressions like this one that you're seeing here show at the moment, it looks like the consumer is paying for a decent chunk via higher costs. And the US businesses are seeing some margin compression as well. The gray quadrant there is kind of worth highlighting. People will change supply chains and maybe more over time to minimize the tariffs, not necessarily avoid them, but just find suppliers that don't have the additional tariff costs if they're from high tariff countries, which is kind of the design of the tariffs. But speaking of that, it's interesting to sort of look around the world and see whether the amount of the tariffs will really net offset the cost advantages that each of these countries have. So this chart here is kind of interesting because it's looking at the monthly earnings cost of people in different countries around the world, and then it adds on the tariff rate that that country is paying in red, and compares it to the US cost of labor. And so you can see countries like Canada and Germany have relatively high costs of labor. You might expect them to see some shifting away to the US because suddenly the tariffs make US relatively competitive. But a lot of other countries probably won't see the dramatic reshoring or offshoring of manufacturing because they're still so much cheaper, even with the tariffs sort of implemented. In terms of how, I guess, impactful the tariffs are to different countries as well, I like this chart just because it shows how much of each country's exports or how much of each country's economy is exports to America. And so the dark blue line here, you can see Mexico and Canada by far and away the most affected by tariffs. Important to highlight, there is still the USMCA agreement that Trump struck in his first term, which minimizes how many products actually pay tariffs for the moment. So it's not as bad as this chart looks. But then if you sort of cycle down this chart a little bit further, and Australia is right at the bottom there, the amount of exports coming from that from each country is manageable, sort of 4, 3, 2%. You have to find new customers, I guess, if your Americans aren't going to buy the products anymore, but it's not from a countrywide impact as bad as maybe people think it is. And that's because not everything has a tariff attached to it. In terms of what the market thinks, this chart shows the market actually thinks America might be doing a little bit more harm to itself than it's doing to other countries. So ever since that Feb 1 starting point, you can see Europe, which is the gold color here, and Asia, which is the red color, has actually, the stock markets have outperformed the US. You can see the big sell-off in April with the reciprocal day tariffs where every country was probably going to be hurt by the additional costs of trade. But then also, as we've seen deals and we've seen sort of a little bit more data come out, the recovery of all the different regions has kept Europe and Asia in front of America in terms of the stock market. So what do I think about going into this year and into next year? I think there's 3 tailwinds for stocks, which are pretty interesting. The first one is rates in the US, which are coming down again at last. And some of you might have been keeping track of why the Fed started to cut rates again. It's all because the labor market is now weakening. Inflation hasn't really come down from where it was when they started to pause, but they did pause because they worried that tariffs would increase prices and restart inflation. So the fact that inflation hasn't restarted dramatically, now they're focused on hiring and the jobs market. What's important, I think, from this chart is actually the jobs market has been slowing for a couple of years. So it's not like the data suddenly changed. I know there was a revision of 1 million jobs that came out of the statistics, but in reality, the jobs market in the US, which you see in this green line, has been softening for a couple of years. I think one of the things that's been really positive for the US economy is the red line, which is layoffs. They just haven't picked up either. So no one knows someone that's lost a job, and that means that they're all the workers are still pretty comfortable in their jobs. They're not budgeting for a rainy day, and so this consumer spending is still actually holding the US economy up pretty well. When we look at interest rates, you can see here what we just talked about, that blue line that kind of goes horizontal as the Fed paused their cutting of rates to see whether the inflation would come through from tariffs. And now they've restarted. Last week, they actually cut another quarter, which is not in this chart. But you can see the blue line, which is the forecast, show US rates getting down close to 3%, maybe even a little below that by the end of next year. You can also see a lot of the other countries that we're focused on here have got rates down to a level now where it looks like maybe we can pause in a lot of countries. And that's because the interest rate is pretty close to the inflation rate of each country. And so the real return on bonds is pretty low. And if in mathematical terms or in economical terms, I guess you could say, when you have that environment, the interest rate's not contracting and it's not expansionary anymore. It's the neutral rate. And in reality, we've got a pretty Goldilocks set of economies. We've got unemployment that's going up, but not badly. So not too hot, not too cold. And we've got inflation that's come all the way back down from highs of sort of 7, 8, 9% globally to almost 2%. So again, not too hot, not too cold. So it makes sense that rates get down to those neutral levels. That's really good news for, I think, the small cap and maybe mid cap stocks in the US, because this chart here shows the amount of interest expense as interest rates went up in that sort of last couple of years because of the Fed policy, and how much of their earnings was getting soaked up by paying interest. And so for the small cap space, it got to pretty close to record levels for the century, close to 50% of their earnings being soaked up by interest expense. So if interest rates start to come down, you should see small cap actually start to increase margins, increase profitability, and that'll be good for broadening of what's happened in the US in terms of the profitability across companies. The second tailwind, I think, is tax cuts and deregulation, which might be a more US-centric thing. We've obviously had the big, beautiful bill. The Republicans are very focused on deregulation. And so you can see here, the yellow zone in this chart shows the big, beautiful bill is net stimulative. It's going to, all the tax cuts for companies and individuals net out to a boost of spending, which should flow through into the economy. The right-hand side of this chart shows that it's actually more beneficial for higher income earners than for lower income earners. But what's interesting about that is in the US, we've actually seen the consumer spending increasing in the higher income bracket, and that's been helping continue to drive the consumer spending strength in the US. And then the third thing to talk about is AI. And I think the reality is AI is now real, and it's real earnings, which is the first thing I want to focus on. So looking at this chart here, this is for since 2024, so almost 2 years now of returns. The returns are the bars. What's interesting is the dots are the earnings growth. And so for me, I sort of look at the outperformance of the Nasdaq 100, which is obviously a fairly tech heavy, it's an AI heavy, it's also biotech heavy index, is outperforming even the S&P 500, which has a lot of the same companies. But definitely both of those indexes are outperforming the earnings growth and the returns from Asia, Europe, and even US small caps, which we just talked about. So this is fundamentally driven in terms of why the stock market's been outperforming, why the US mega cap growth has been so popular, is because earnings has been growing for those companies. And the reason the earnings has been growing for those companies is right here. It is all about AI spend. And so it's real revenues for all of the hyperscalers, building out, I guess factoring the AI models, building out cloud compute and data centers so that AI can be implemented. And in theory, that will translate into future revenues for all these companies as well. You can see the scale of the money here. It's $250, $350 billion a year, plus additional if you start to factor in other software costs. So it's a big number. It's a lot of money, which is a lot of revenue, but it's also an interesting question from a CapEx perspective, which is what this chart's also showing. If we think about the revenue aspects just for a little bit, what's interesting about comparing what's happening now to what's happened back in the 90s when we had the tech bubble is back in the 90s, all the tech stocks, you can see the price earnings multiple got quite stretched. So it got up to about 50, where the prices were high and the earnings had not gone up to offset that. And so the stocks looked what we call rich, I guess, and price earnings is a pretty classic valuation tool. We started to see a similar thing happen where those largest companies, all that AI complex started to get rich. But what's interesting in the last few years is those earnings are actually now starting to catch up. And so the price earnings multiples for the companies are actually coming down. So the companies, you could say, are earning their way into their high multiples. Another way to look at it is the stock market is built to forecast the companies and pick the companies that are going to grow more strongly. And so they go up before their earnings go up. And the stock market looks like, at the moment at least, they've been mostly right on that. The other thing is AI is definitely driving the real US economy. And maybe this chart's the easiest one just to prove that point. This shows the amount of construction happening in data center builds compared to the amount of construction happening in offices in the US. And so since you could say the ChatGPT launch, you could also say sort of the recovery from COVID, office building has contracted pretty significantly, but it's been more than offset by the growth in construction spending in data centers, which is obviously hiring a lot of people in the construction sector and keeping that sector growing. And obviously the wages in that sector keep boosting the GDP in the US as well. Interesting question from a CapEx perspective is, are we spending too much on AI? And so a lot of people are starting to think about this now. And some of the more interesting charts are ones like this one, where they compare the amount of money that's being spent on AI to something else that was kind of revolutionary recently, which is the internet. And remember, the internet created a lot of connectivity that we take for granted today. Things that it allowed happening on our smartphones, wouldn't have been able to happen without the internet. But then also thinking about things like railroads, which back in the 1800s changed a lot of how companies could sell to more customers, transport goods more productively. And so these are like big shifts in how the economy works. You can see AI and the internet aren't nearly at the scale of what was spent to build out the railroads. The reason that the pink bar is there, if you read the underlying study, is the railroads. I mean, I still go home in America on one of the railroads that was built back in the 1800s. So the productivity gains from it have persisted for over 100 years. The theory is the internet and some of the AI gains, just because of how fast technology changes, might actually have to be realized more quickly. And so the depreciation adjusted version kind of puts them in a scale that kind of times out the spending that's being done on them in a more fair way, I guess you could say. The point, I guess, of all of this, and really the way to think about it from an economics point of view is, if you look at this chart here, this focuses on the left in the 90s and the noughties when the internet bubble happened. And after the internet bubble sort of deflated in 2000, you see that benefits of the internet that I just talked about, the connectivity benefits, and how productivity, which is the black line here, stayed about 2% higher for 10 years. So just doing simple math, that's 20% increase in GDP. And to kind of put that in perspective, the US economy is about a $30 trillion economy. If we could increase the productivity of the country and increase GDP by 20%, that's $6 trillion. So it does put in perspective the amount of spend that we're seeing at the moment, and perspective, whether we have overinvested in AI, if it really is going to change productivity like the internet did or more, then potentially the cost benefits for the spending that we're expecting to see as well could still be positive for a while. So if investors want to buy the AI story, this is where I guess the back half of my year has got super interesting, because talking to investors around this region in Asia, if you want to buy the AI trend, there's some stocks in Taiwan, obviously Taiwan Semi, that are heavily involved in the chip building part of AI. But really, as this chart shows, the investment in AI is predominantly US. The hyperscalers are predominantly US companies. They are all, I'm very proud to say, listed on Nasdaq. So there's been a lot of people trying to buy US companies, even in the Asian region. And so there was an academic study done looking at overnight trading from America's perspective, so actually trading in the daytime in Asia. And you can see the chart shows a lot of it's coming out of Korea, but the rest of Asia is sort of an equal 40% component. So Asians are getting much more interested in buying US stocks. They're available to them. And you can see that they're actually making up a lot of this overnight US trading, which, in case you're not aware, is actually leading US markets to try and expand hours to be more like futures markets, trading 24 hours a day, with market makers putting public quotes out publicly in the system. So in the next couple of years, the expectation is we will have US stock markets trading 24 hours a day. Interesting question is, what are investors buying, or at least trading overnight? And so this chart here breaks down the top 15 tickers for a period. And you can see the blue colors are stocks. A lot of them are those Mag 7 tickers. Tesla and NVIDIA show up here as the two of the biggest. And then if you look at the orange color scale, that's all ETFs. But again, it's S&P 500 ETFs, it's Nasdaq 100 ETFs, it's large cap US, growthy kinds of stocks, most of the way down. So a lot of it's ways to express the AI theme by buying large cap growth US companies in ETFs or in single stock form. So I just want to finish by talking a little bit about how market performance is broadening out, because we've talked a lot about how well the US economy has been doing, how well the US stock market's been doing for the last couple of years. This year in particular, the US market's still doing pretty well. Nasdaq 100 there's got pretty good returns, but actually Asia Pacific equities are doing a little bit better. International equities are doing better. Emerging market equities are doing even better than that. So you're definitely seeing a broadening out of returns across small cap in the US and around the rest of the world. Equity markets are benefiting from lower interest rates, from the fact that unemployment's still really low in the world, gives consumers a tailwind, and we're starting to see some increased margins in companies. So with that, I'm happy to take questions. Just none that are too hard, right?
Well, there are no guarantees here, Phil, because we have got some very good questions coming through from our audience. Please keep sending them through. You'll note that there's a comment section on most of the platforms you might be watching on. Please feel free to enter your questions, and we'll get to as many as we can in this session. So some general questions here, Phil. Some of them were sent before your presentation, so I know you've addressed some of these issues. But in summary, we've got a lot of questions around this idea, and that is that the US market's rise this year has been incredible. How much of it do you think is driven by AI-related optimism versus actual earnings growth from tech companies?
Yeah, and I think the chart that we had with the dots and the bars kind of shows it's actually a lot of earnings growth. The fact that the PE multiples are coming down now, the earnings are catching up to the price appreciation. If anything, the Mag 7 has kind of gone a little bit sideways as the earnings have caught it up. So we're starting to see the earnings really come through as support, which is why people are starting to ask, like, are the growth forecasts built in still achievable, or when are we going to hit, I don't know if you want to call it peak or maturity of AI, and sort of move on to implementing AI in products?
Right. And another chart that you had suggested that we're a long way from that peak as yet.
Possibly, yeah. I mean, it's interesting looking at the amount of, I guess, capacity in the ChatGPT type functions. Every time you sort of release a new ChatGPT, you get 10 times the improvement in performance, and there's got to be a point where you've got a good enough model that you can start to put it into products. So you think about ChatGPT 3, it had problems with hallucinations. Like, you couldn't put it into a product and let customers just talk to the AI.
Right.
But I think we're getting closer to the point now where it's able to re-engineer itself, make sure that it's fact-checking itself and not making things up so much. And that's when you can start to become more productive as a company downstream. So we don't need to be on the cutting edge actually building chips to make money out of AI. We can actually lower our costs if we're using AI in our products.
Right. Understood. And in fact, it's a point that Jay Powell spoke to very recently. I saw that he made a comment, and he stopped short of naming companies, but he drew the comparison that you've drawn to our attention today, and that is the difference between the current times, the AI boom, and the tech bubble of 2000 is that there really are earnings underpinning this one.
This one, yeah. I mean, there's other charts I've seen. The free cash flow from the hyperscalers is being used to invest, and it's about 30% of their free cash flow. So it's not even like they're levering into the AI trade. They've got a lot of revenue already, and they're using some of it to build out the AI, thinking that that's going to be their next revenue source, I guess, competitive advantage.
Right, so it's funding itself.
At the moment, yeah.
Okay, strong. Speaking of the Federal Reserve's chairman, we've got a perennial question here, Phil. Federal Reserve Chair Jerome Powell has indicated there may not be a rate cut in 2025. So this person asked, do you think there will be one? I'm going to add to that and ask, which way do you think the next move in US interest rates is?
Oh, I think it's down.
It's definitely down?
Yeah.
Okay.
I still think we'll get something in December.
Okay.
I saw a really interesting chart. We talked about, in my deck, we talked a bit about how other countries have got to that neutral rate, where they're almost at the level of inflation, just plus a bit. And so that's enough interest to kind of attract money into deposits, but not so much to slow mortgages and investments down. The US is still kind of just above that neutral rate banner, and so they could definitely come down a bit. I mean, we have a Goldilocks economy in a way. We have pretty close to all-time low unemployment, but it's ticking up, so that's not too hot, not too cold. We have inflation down to 3%. It's not really ticking up, so not too hot, not too cold. If you look at the demographics around the world, which is the other factor I think is really interesting, there's one continent in the world that's actually having enough babies to grow its population, and that's Africa. Right. All right, so the US is just like Europe has been 10 years ago, Japan was 30 years ago. Its population's starting to age. The workforce is going to start to shrink. And as that happens, the amount of the need to buy new houses, to build new houses, to buy white goods, extra cars, it's just not going to be as potent as it is when you've got a young population with 3 kids coming out, a lot of population growth. And so the natural level of heat in the economy is going to be lower. And so I don't think we need a 2.5% above inflation interest rate to keep the economy bubbling along. I think we need something closer to zero. And you can kind of think back when Japan started to shrink, it put its interest rates to zero.
Yes.
And it didn't stimulate its economy. When Europe started to shrink, it was actually 10, 15 years ago, it went negative interest rates, didn't stimulate its economy. So I think those 2 proof points show that as we're all aging and having less babies as a globe, we should expect that interest rates are not going to actually need to be as high as they were back in the 70s when we had a lot of kids, a lot of population growth, a lot more demand for stuff.
So the natural level for interest rates in developed nations is going to go lower as its population ages.
Yeah, I think it's hard to avoid that just because you don't need interest rates to go up much to slow growth down.
Right.
Yeah.
Okay, very interesting point. AI, we've got plenty on AI this afternoon, Phil. AI is computationally intensive. What sectors can benefit from the computational requirements of AI?
I know, this is kind of interesting question because I was, as you know, managing money in the 90s when the tech bubble happened. And we went from buying tech companies to buying tech, media, and telecom. Right. And that was because the tech was so expensive. It's like, it's this question, right? Who's downstream going to benefit? And at the time, it was like, well, maybe media because you'll be able to put stuff on the internet. And I guess Netflix is proof that was right. Yep. And then maybe telecoms because we need all these pipes to put the data through, which is true. Like we have optic fiber instead of DSL, and we went from 3G to 4G to 5G. The problem for the telecoms was they didn't actually make any money out of it because they were constantly trying to keep up with the capacity and the technology of the time. So they were capexing so much they couldn't really make money out of it. I guess Netflix is an example of if you could have picked a winner, like using the rails that were built is how you make the money. So I think what's going to happen with AI, like when do we sort of pivot away from building the factoring the models to putting it into products, and who will actually be able to make their products better or make their products cheaper? I mean, that's the fun part of being a stock picker, isn't it?
Absolutely.
We got to look at the business models, think about how the world might look in maybe 5 years or 10 years, and find the companies that are actually going to win in the environment where maybe AI is being put into their products.
Right, okay. So those ultimate users, those, as you say, who glide along the AI rails are the ones who might be the ultimate winners?
Maybe. I mean, yeah, and in terms of the productivity gains for the economy, true as well. I saw a really interesting presentation talking about the iPhone. And it's like, if you remember the productivity chart we had, where the productivity came after the internet, it didn't actually come after the iPhone, which was 2006-07. So as good as the iPhone and all of the smartphones are for us as consumers, hasn't done anything for productivity as an economist. So you do hope that AI doesn't turn out to be like a consumer savior, which is what it's doing right now. Like we're all using ChatGPT and we're all using AI in our internet searches. We really need to get AI to work for companies as well.
Right. So somebody can profit from it.
Well, or save costs.
Yes, save costs. Yes, might be a better way to put it. Okay, moving on, Phil. Why is the US market rallying strongly despite the US government shutdown and rising debt levels?
Yeah, so the shutdown itself, if you look historically, and we've had a long shutdown under the first Trump administration too, doesn't tend to do that much damage to the economy. And that's because the workers that are not working right now for the government will actually get back pay when all of the budget stuff gets reapproved and we get going again. Okay. So I guess you could say the government hasn't done any work for this period, but the cash flow will come back. And so the people might be using their credit cards now, and then they'll pay their credit cards off, or they may be not buying right now, but as soon as they get their money back, they'll go out and buy things. So it might kind of create a little bit of a delay or a hiccup in supply and demand networks, but it doesn't actually historically do that much negative to GDP.
Okay, it's demand delayed, not destroyed.
It's correct, yeah. It's definitely not income destroying at all because most people will get paid out once all of the budgeting gets reapproved. Okay. So the deficit part of that question's kind of not really related to I guess it's related to the shutdown in the sense that the shutdown is partly because the government has a big deficit to close, and the main obstacle right now is related to Obamacare and whether the subsidies continue or not. If they do continue, the deficit will get worse. Right. And so that's kind of what's holding the approvals up right now. But really the deficit, which is a lot of what we talked about in this deck, is a bigger problem to solve. I think there's three ways we could get out of it. One is to broaden the tax base, which is tariffs. Yep. One is to inflate out of it, which, like we just talked about, it's going to be hard with the demographics we talked about. Yep. The other is to grow out of it, which is where AI might come in. Okay. And so I guess time will tell. Right. But you definitely have a risk if we can't do one of those three things, that the debt goes up so much that the interest starts to be a huge proportion of the actual budget every year. And so your debt's going up just because you can't pay the interest off, which is not a good financial situation. You could sort of think about a classic recent example was the Liz Truss government in the UK, where she had a fairly high, you saw UK had a fairly high debt to GDP ratio, and she introduced a bunch of tax cuts without really cutting spending. and the whole financial system's like, I'm not sure you deserve the credit risk that you've got right now. I want a premium on my debt to account for the chance that you might default in the future. And all of a sudden, pension assets have to need to be refinanced, and the cost of them doing anything went up, and so that makes the problem even worse. So there's a risk that the debt gets out of control unless we can do one of those three things to really tackle it.
And that's why bond market vigilantes is a term that scares so many politicians, I guess.
Yeah, so the bond market, I mean, for anyone that doesn't know what the bond market vigilantes were, they were bond traders that eventually said, I'm not accepting like this level interest rate for the credit risk that I perceive. And so right now, I think you could look at the US like 10-year market. The interest rates have been going down, which makes the bond prices go up. There's no one really saying I don't trust 10-year credit in the US, even though we've had the 3 rating agencies downgrade us. But at some point they might, and that's when they call them vigilantes, because somebody tips the scales and says, I'm going to diversify away from US debt.
And in a mini way, that's what we saw in April when the US 10-year sold off to about 485. It's now rallied back to be closer to 4%. But that April sell-off after the introduction of tariffs appeared to be one of the factors that saw tariffs reduced or delayed at least.
Yeah, because normally you would see a flight to quality, which would be the risk-free asset, which would actually reduce. Yeah.
So it's an opposite effect. All right, well, we've got plenty more here, Phil. So, all right. Now, I don't know if this is one that you want to speak to, but the technical analysts using Elliott wave patterns suggest the index is in wave 5 of a bullish cycle from the April 25 lows, with potential for further extension before a multi-wave correction. Now, I know you've got plenty of charts here. Where do you see the peak for the S&P 500 in this bull cycle?
Wow, that sounds like someone who knows more about trading than I do.
They certainly seem to be strong with their Elliott wave
That's
analysis.
for sure, yeah. I mean, I think it's going to really depend. I'm more fundamentally driven.
Right.
We can see that the earnings have been growing with the stock market. And so it doesn't really look like there's a dislocation on that sense yet. It will be interesting to see if tariffs slow the economy enough that companies do want to let people go to kind of keep their margins growing.
Yep.
And then you'll see a change in the fundamentals. Yep. One of my favorite charts is to look at that layoffs chart, because I think if companies start to lay people off, it's because they're trying to save money, which means the consumer's not keeping the economy going like it was.
Right. Okay, and that's when the downwards
spiral. To me, that's one of my warning signals.
Okay.
Not Elliott wave, but that's because
well, we all have our own signals, and we'll have to find our own approach. So that's fair. Can you see the S&P 500 reaching 7,000 this year?
I mean, possibly.
Yeah. This is a hard question for anyone to answer, because none of us know the future with certainty. None of us can say certainly whether or not it will reach 7,000. But I would argue that there's an uptrend in place, that momentum's there, and the fundamentals have not deteriorated. So.
Yeah. We're in the middle of Q3 earnings now, though. So in terms of like an impetus that's fundamental, we only got a few more companies to report. So, I guess you could have like a re-revision of forecast from the commentary, or you could have, you're not going to see things like revenues and sales from Q4 until next year.
Right.
So we kind of have to, I think we have to hope that the good news happens in the next 3 or 4 weeks to get us there.
Right.
Or some other catalyst that we don't know about yet happens in November.
Right, okay. And I'm sure somewhere in here there's a question about a Santa Claus rally. Phil, do you care to comment on
Santa Claus?
Phenomenon? Yeah. Think we're going to see Santa Claus this year?
I hope so. My daughter hopes so.
Good answer. Okay. Well, similar sorts of questions. With the US market hitting record highs, are we nearing a correction phase? And what indicators should retail investors watch out for early signs of a reversal?
Yeah, so that's my favorite indicator is the layoffs in the US. And I just think, like, for the last 3 or 4 years, remember 3 or 4 years ago, everyone's like, we're going to have a recession. And I think the reason we haven't is the consumer has just stayed so strong, especially in the US. Europe, everything's kind of weaker, but also not falling. So growth has been slowing, but not gone negative. I think if we see layoffs, it's a sign that companies are seeing weak sales, weak revenues, probably not expenses going up anymore, but enough that they need to actually start to resize their business. And that's going to hurt the consumer confidence, and that's going to hurt spending, which means more companies have revenue target misses and they have to let people go. And there's a economist, Claudia Sam, who's done a lot of research in the US on the unemployment rate going up. And she basically finds that if the rate goes up by 0.5% in half a year, it causes that kind of a feedback loop that makes it go up another 2 or 3% and we have a recession.
Okay.
Yeah, I mean, technically it got triggered when our rate went up from like 3.4-ish to 4. But a lot of people are like, oh, but there's some technicalities in how that all worked. We're kind of close recently to touching that level. So I think the layoffs is the one thing that have helped us get through it, because no one knows someone that's lost their job. And I know I'm generalizing, but I remember back in like the credit crisis, everyone knew someone that had lost their job. And so everyone was worried it was them next, and you all stopped spending at once. And that's what Claudia Sum finds. It creates a feedback loop, which means companies kind of let more people go, and then you have a recession.
Okay. Well, this week we've got the JOLTS numbers, and then we've got on Friday the non-farm payrolls. Do you put any weight on these particular releases in thinking?
I mean, they show you the trend.
Yeah, right.
I mean, and the government with the shutdown too, some stuff's getting delayed, but reality is there's a lot of alternate data, to your point, that kind of indicates how the hiring is going. The reality is the trend in America has been for 2 or 3 years, like we showed, slowing labor. I mean, kind of getting back down to more normal levels, actually.
Right.
Coming out of COVID, we had so much stimulus. We had so many people who didn't really want to work because they didn't want to come out in public. We had 2 jobs for every 1 person looking, because everyone wanted to go back on vacation. Everyone wanted to go back to restaurants. Everyone wanted to go back watching entertainment, but no one wanted to actually work in those businesses.
Right.
So we had a lot of wage growth on the low end because of that. Where we are now, we're just under 1-to-1, which is a more sustainable level. Again, not too hot, not too cold. Right. But I think that's kind of important for the worker, is we still have enough jobs for the people looking, but we haven't seen layoffs.
Right. Okay, I'm watching that balance very closely.
I am.
Fair enough. All right, just taking a slightly different tack here, Phil. Is gold an effective hedge against the equity market? And there's more to it. Gold rallied along with equities for a few months, but is now divergent. Why is that? And will the equity market slow down as gold has and not keep hitting new highs?
I mean, this is the question right now, is like, why is gold going up so much so fast? Even Bitcoin hasn't caught that rally.
No.
And looking at central bank buying, I know a lot of people say, well, maybe the central banks don't want to buy US dollar because of the tariffs, or don't want to buy US dollar because of de-dollarization. There's no evidence of that in the data. And I think the reality is the US debt market's still so big, you can't move away from that. The central banks have been buying gold consistently at kind of the same rate for the last 3 years, and buying for the last 10 plus. So it's not like central banks have suddenly boosted buying. No. It looks like it's on the margin, or maybe it's ETFs, or maybe it's retail starting to do inflows into gold. And I saw a chart that showed big outflows last week when the price did correct. Right. So it looks like it's kind of demand on the margin that's retail demand, rather than central banks doing it. Having said that, that doesn't speak to whether it's a good hedge. No. I mean, normally it's like the risk-free, or the risk-off trade is to buy gold, buy bonds. I feel like gold, where it's at right now, is kind of a different level. It's got really expensive really quickly.
Yeah, hasn't it? Yeah, it's hard to argue that buying gold at $4,000 an ounce is a defensive play.
Yeah.
Okay, we've had another one on gold there. We've touched on that. Will a downturn in the US market lead to a global stock market decline?
Probably, just because it's 50+% of the market cap. Yeah. The reason that the market's downturning is probably because of global earnings, because most US companies are global, especially the large cap companies. I mean, the Nasdaq 100 as an index is kind of interesting. You think of it as like very American techie companies, but actually the earnings in the Nasdaq 100 are 50-50 US and international. So yeah, if we see the US market sell off, it's a reflection of the global economy slowing. The interesting thing will be in the details, right? Is tariffs slowing the US companies more than the rest of the world? I mean, there's a lot of theories that Europe will start to deregulate as well. It will be getting more stimulus coming through in its defense sector if the US doesn't keep supporting the European and the NATO agreement. And so they'll be investing in themselves a bit better, which will increase their productivity. So there's a few outcomes that actually could have a less, I guess, correlated result. But yeah, I think from an equity performance perspective, it's beta. And so if the market does start to sell off, it'll hurt everyone a bit. Yep. Having said that, if we look at the outperformance of the US stocks, or that AI outperformance, if the reason the US market is selling off is it's an AI sell-off, it shouldn't filter through to the European market or the Asian market quite as much, because they didn't benefit on the way up either.
Right. Yeah, just this. they should remain at that lower beta on the way down as well.
Yeah.
Of course, shoulds don't always play out in the market the way we think, but it's an interesting part of the market. Do you think at the moment globally, I mean, we're seeing a lot of asset classes near all-time highs. Are there any markets or sectors do you think could be argued are cheap or at least good value?
I mean, value itself has underperformed for so long. You'd like to think with rates coming down that maybe some of those companies with decent revenue streams, dividend payments could become more attractive, especially if bond rates don't actually go up as much as we had seen historically.
Right.
Then our dividend stream might become relatively attractive again compared to even a bond fund.
Right.
So I think there's an argument that value could come back into vogue, but I might have said that over and over again for the last 10 years and been wrong.
We have been waiting a while, haven't we?
I
As have a number of fund managers.
Yeah.
So, all right. Not an easy call. Well, we're getting close. We've probably got time for just one more question, Phil. So let's make it a good one. How should the geopolitical landscape, conflicts, trade tensions, etc., be factored into a long-term risk assessment for a US-focused investment portfolio?
Wow, that is a tough question.
Yeah, that's one for a fund manager.
Yeah. I mean, the thing about geopolitics, we've had some pretty interesting geopolitical events in the last 6 or 7 years. Apart from COVID, the Ukraine conflict, Middle East conflict. I mean, normally wars like that on that scale would cause the equity market to sell off. They would cause economies to freeze up. I think we've been kind of lucky, and I say this as an economist, not as a humanitarian, but lucky that it hasn't affected the oil complex that much. And so the economies of the world have still been able to function, have energy to do, like heavy industry. The costs haven't gone up because oil prices haven't gone up. So we've been a little bit lucky. There's been plenty of geopolitics and it hasn't materially affected companies. Definitely had a humanitarian effect. I wish I could have stopped it, but the geopolitics is still there, always there. It depends what kind of geopolitics we get, I think is the short answer to that question. And I guess one of the things about geopolitics is you don't know what's the next flare that's going to go off until it happens. And that's why when it happens, usually the market does sell off aggressively because no one's really been thinking about it.
Right. Okay. Another one to watch out for.
Yeah, but we should focus on earnings growth because that's positive.
Because that's what we know. All right. Well, thank you very much, Phil. It's been a pleasure having you on. Very interesting presentation. I'm sure a lot of our viewers have learned a lot from today's session. So many thanks for joining us, and we look forward to speaking with you again soon.
You're welcome. Thanks for having me.
Thanks, Phil.